In the ever-evolving landscape of global politics and economics, the recent escalation of trade tensions between the United States and China, alongside other global power plays, has become a focal point of international discourse. This is not merely a series of policy adjustments, but a dramatic showdown that could have far-reaching consequences for both superpowers and the global economy at large. President Trump's decision to raise import tariffs on Chinese goods to a staggering 125% marks a significant shift from previous strategies, signaling a move from containment to full-scale economic pressure. This decision has far-reaching implications, affecting not only industrial materials but also essential consumer products such as electronics, home appliances, and auto parts. For American businesses, especially small and mid-sized ones, this translates to soaring production costs. And for everyday Americans, the impact is already visible on store shelves with rising prices. While the policy is aimed at exerting pressure on Beijing, the repercussions are reverberating through the U.S. economy, potentially hitting it as hard as or harder than China. In retaliation, China has not hesitated to strike back, increasing tariffs on American imports from 34% to a staggering 84%, targeting key U.S. exports like soybeans, beef, automobiles, and electronics. These measures are strategically aimed at U.S. farmers and export-dependent industries, hitting where it hurts most. However, the real shock to global markets comes not from these tariff hikes, but from the looming threat of a more devastating move, a potential sell-off of $900 billion to $1.1 trillion in U.S. Treasury bonds. This move is described by experts as a financial nuclear bomb in the ongoing economic war. China, being the second largest holder of U.S. debt, holds substantial leverage, and such a sell-off would create shockwaves that could affect every American household. The implications of a large-scale bond dump are severe, as it would lead to plummeting bond prices and skyrocketing yields, resulting in increased borrowing costs. For everyday Americans, this means higher mortgage rates, steeper car loans, and piling credit card interest, all while paychecks remain stagnant. The weakening of the U.S. dollar due to reduced bond purchases by China would also lead to a surge in the cost of imports, affecting everyday necessities like fuel, packaged foods, and electronics. The financial markets are already reacting, with the 10-year Treasury yield jumping by 0.4% in just a week. This has rattled the housing market and sent Wall Street into a tailspin. However, the situation is not without risk for China. A mass sell-off of U.S. bonds would devalue their remaining holdings, which constitute a significant portion of Beijing's foreign reserves. This move would be akin to burning cash to make a point. The deep economic ties between the U.S. and China mean that a major shock to U.S. financial markets would also impact China's exports, weaken the yuan, and threaten global investments tied to Chinese assets. Economists often refer to this as a lose-lose scenario, where both sides suffer significant losses without gaining a strategic advantage. In response to these tensions, Beijing appears to be switching tactics, opting for a strategy of soft control with long-term impacts. This includes gradually reducing USD purchases, quietly trimming U.S. bond holdings, and most importantly, building a parallel financial system powered by the digital yuan, or ECNY. According to unverified reports, by the first quarter of 2025, the ECNY has processed over 1.88 trillion yuan in transactions across more than 200 countries and regions. This development represents a silent financial revolution, challenging the global financial architecture dominated by the U.S. for nearly a century. Amidst these tensions, the U.S. has also targeted Japan with a 25% tariff on imported cars, singling out Japan as a primary target. Tokyo's response has been strong and assertive, with the Japanese government warning of retaliation if the U.S. continues to impose harmful tariffs. This situation is not just a trade dispute, but a broader message about the unacceptable nature of America's policies. Japanese media are now calling for a more independent foreign policy and the establishment of new economic alliances, not just with the U.S., but also with other powerhouses like the EU and Canada. Japan's economic ties with the U.S. are significant, with over 1 million Americans working for Japanese companies, primarily in manufacturing. Japan is also the #1 direct investor in the U.S. for the past 4 years. However, if these economic ties are broken, The consequences could extend beyond job losses to a significant decline in strategic cooperation between the two nations. Japan is also making strong moves in the defense sector, increasing its defense budget and investing in military technology, which could impact American defense contractors and shift military partnerships towards European countries. The defense sector is not the only area where Japan is making strategic moves. The country is also considering limiting the export of core technologies, particularly solid-state batteries, which are crucial to the electric vehicle industry. If the U.S. imposes tariffs on Japanese electric vehicle technologies, Japan might halt the export of these batteries, significantly hindering the development of electric vehicles in the U.S. This is happening at a time when the U.S. is trying to boost electric vehicle production, making it a critical area of concern. Japan is also expanding its trade relations with the European Union, which could help reduce its dependence on the U.S. market and create additional opportunities for growth in other markets. The EU has signed trade agreements with Japan, facilitating market expansion and mitigating risks from potential U.S. tariff hikes. Additionally, Japan is increasing electric vehicle production in these markets to maintain its competitive edge. The EU is not only an important market for Japanese cars, but also a strategic partner in providing new electric vehicle technologies. These developments raise critical questions about the future of U.S.-Japan relations. Will Japan be able to force the U.S. to change its tax policies, or will the U.S. continue to take a hard stance, causing widespread financial impacts? We invite you to share your thoughts in the comments below as we continue to explore these complex issues. In another significant development, President Trump's decision to impose tariffs on EU goods has provoked a strong response from European leaders. The European Commission has responded by targeting America's Achilles heel, big tech companies like Meta, Apple, and Google. These companies rely heavily on the European market for revenue, and the EU's actions involve tightening regulations and imposing digital taxes. This strategic move doesn't involve traditional trade wars, but instead focuses on controlling data and imposing financial constraints on tech giants. The EU's actions are not isolated, as other countries, including Australia and Canada, have also voiced strong opposition to Trump's tariffs. These tariffs have not only strained diplomatic relations, but also raised concerns about their impact on global trade and economic stability. Experts warn that the U.S.'s unilateral actions could lead to a fractured trade relationship with key allies, potentially impacting the global economy. As we navigate these turbulent times, it's crucial to stay informed and engaged. We encourage you to subscribe to our channel for more in-depth analysis and updates on these critical issues. Don't forget to like and comment on this video and share your views on the ongoing trade tensions. Your opinions matter, and we look forward to hearing from you.